All right, everybody, welcome back to the live stream. I am JC Peretz, and I am joined by my esteemed colleague, Mr. Sean McLaughlin.
What's happening?
What's up, Shawnee, baby?
How you doing, man?
You know, I love our Wednesday analyst meetings. I really, really do. We talk about so many things that you are not interested in, global rates and yield curves and spreads and none of that stuff. And then when you hear Freeport McMoran and you hear high volatility, that excitement just oozes out of you, Sean.
Well, JC, it really just comes down to I like to make money. So if I hear an opportunity that sounds exciting, then I get excited. And before that, you guys just weren't exciting me. Nothing sounded good.
Touche. So, this is one of those things where it's either a good buy or a goodbye, right? It's one of those things. It's either gonna, and that happens, right? It's not like one of those things where it really happens every day or every week or every month or even every quarter. But you and I have known each other for a long time, and I just recall on multiple occasions us having a very similar conversation. In this case, it's copper and Freeport McMoran. So let's just lay out sort of the global macro implications here with one chart. And this is copper. Is it either a massive head and shoulders top and copper's going to come tumbling down, or is just this a healthy consolidation within an ongoing uptrend that is going to resolve in the direction of the underlying trend, which would be perfectly normal, right? So that's the question. Sean is still at the point where he doesn't care quite yet. He's intrigued by the copper, but doesn't care quite yet. And then, of course, can't have a conversation about copper without bringing in the one Freeport McMoran. Sean, like I said, like copper, it's either goodbye or goodbye.
Well, you mentioned the head and shoulders pattern there in that previous chart. And I do recall you writing this weekend or earlier this week about how your favorite head and shoulders patterns are the ones that aren't head and shoulders patterns at all. So that's kind of what we're thinking here is if this head and shoulders, if you want to call it that, if that doesn't play out, then the opposite is going to be pretty nice. And so we're willing to make the bet here that this 30 level in Freeport McMoran is gonna hold here, at least in the short term. And the beauty is what, when we were talking earlier this morning about what we were seeing, what we wanted to play, the first thing I said to you, JC, was whatever play that we do, for me, I want it to be involving selling premium, because with the premiums that were, with the VIX elevated this morning and all week, really, it just feels like the market is offering us some edge if we are net premium sellers on most trades right now. That's not always the case.
And that makes a lot of sense, Sean. And we get a lot of questions from people. It's like, well, why don't you just buy the calls? Or why don't you just buy the puts if you're bearish? Why can't you just keep it simple? And it's like, well, first of all, we are still keeping it simple, but it's not so much about creating an option strategy and always forcing that upon the market. It's about first identifying what type of market environment we're in. Are we bullish? Are we bearish? Is it high volatility? Is it low volatility? And then depending on the type of market environment that we're in, then we decide which strategies are best for that environment. And if you nailed it, right? You're like, JC, I don't want to put on an options trade unless we're collecting premium somehow. And I'm like, well, that makes perfect sense with high volatility. As you can see, implied volatility has certainly picked up over in recent times. So if we're going to be selling premium and collecting that cash, why not then take that cash and buy out of the money calls in the old risk reversal?
Yeah, I mean, the situation that I liked here is yeah, I mean, if we want to keep it simple and be bullish, sure, you can go buy calls. And when I just buy calls, I love to buy the 25 delta calls. However, when the options premiums are high like they are now, I'm going to pay a little bit more for those 25 delta calls. I don't like that idea. So instead, I still bought the 25 delta calls, but I'm having a short put pay for them. So now we've flipped the script a little bit. If Freeport McMoran does absolutely nothing from here until November expiration, which is the options that we bought or got into, if Freeport does nothing, well, guess what, JC? The calls didn't cost us anything. The most we'll lose is zero. Actually, we we collected a small little
I was gonna say, we
credit.
might even make money in that scenario.
Yeah, I mean, we collected 20 cents to put the trade on. I don't really care about the credit. I mean, I wrote in the blog post that, don't get hung up on collecting 20 cents. Just try to be, some kind of positive credit when you put it on. But that's not the money we're trying to make here. That's just nice. But really, we just want to get the calls to be paid for by the puts. And we sold the 28 strike put for a couple of reasons. Number one, it was the put that fully covered the price of the call. You can see in this diagram here at the time that I put this little infographic together, the calls are trading for 69 cents. Those puts were trading for 87 cents. So the put clearly covered the cost of the call. Also, it nicely corresponds, that 28 put is also the 25 delta, which I love the 25 delta strikes.
Love it.
And look, a position like this, because of the naked put, does have theoretically unlimited risk, right? The stock could crater on us. Absolutely. That is a risk, and we recognize that risk, and we've sized our position accordingly such that if the stock tanks and we get stock assigned to us because of those short puts, it's not going to be the end of the world for us. But the nice thing is the setup that we're watching, that you, me, and Strazer have our eyes on, is if we're wrong in this trade, we're pretty confident that we're going to be wrong pretty quickly. And the 30 level, if you want to go back to that chart that had the level on there, that feels like the really good level we could lean against. And if 30 breaks, if we can't hold 30, that's when we're going to get out of the trade. Yes, our short puts will still be out of the money at that point, but that's all right. The trade's not working. Our thesis is wrong. We're going to get out of the trade. It'll probably be a loss, but it'll be a small, manageable loss. Nothing to lose sleep over.
But if we're right, we're essentially entering a trade for free that is going to be a home run. So the risk that you just outlined doesn't sound like any big deal, right? If we're wrong, we're wrong. Number one. Number two, what I love most is that we're going to know we're wrong quickly. As we were talking about it this morning, I'm like, we can know we're wrong later this afternoon, right? Or even tomorrow. Like, we're really going to know. And that's fine. There's nothing, we're not here to be right. We're here to make money. So the sooner we can learn that we're wrong, the sooner we can move on to something else, right? That's what I really like. Instead of just sitting around, waiting, getting old and collecting dust. Like, that's no fun. So the worst case scenario ain't that bad. The best case scenario is we've essentially gotten the puts to pay for our calls. So it's almost a free trade, or basically a free trade. We're even getting paid for it, technically, if you really want to go there. And if Freeport rips, it turns into a grand slam, could potentially be one of the best trades of the year. That's right.
Potentially. I mean, that's not my expectation. That's never my expectation when we go into a trade. But of course, we like to position ourselves for that possibility. And on the positive side, if this stock does start doing what we think it's going to do, I've identified the 39 level as a place where I will at least take some profits off the table. My plan is I will close half of my calls and completely close all of the short puts at that point. If we break 39, those short puts will have a very small bid. I mean, you could probably cover them for a nickel. They won't be a whole lot. And I'll sell half the calls, book some profit, already lock that in, and then we'll ride the rest into November and see what happens. That's the plan that I see it as laid out.
All right, guys, you heard it here first. A bullish risk reversal in Freeport McMoran, ticker symbol FCX, taking advantage of this dip in copper. So that means that we're going to be naked short the November 28 puts and long an equal amount of the 36 calls. And if you're lucky, you're even getting paid for it. If we're wrong, no big shakes. If we're right, it's a grand slam. Love it, Sean.
All right, buddy. Take care. This was fun.
All right, guys. Adios.